Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darcy here to bring you the daily recap. Pretty much all the action today took place pre-market. This week we had a raft of strong economic data that sort of heightened expectations for today's jobs report. Everybody, as is customary with the jobs report, everybody's saying, oh, this is the jobs report of the century. This jobs report is going to determine the direction of the market for the rest of the year, first quarter of 2014, all of 2014, for the rest of time. Everybody bills every jobs report whenever it comes around as the jobs report to end all jobs reports, and every single time something comes through that makes it so, oh, actually, next jobs report is going to be the big one. That's going to be what determines everything. And that's sort of what we had this morning. We had all that hype. We had the really strong ISM number on Monday, and then we had yesterday really strong GDP growth, and we had really low jobless claims, below 300,000 jobless claims. So everybody was expecting a big blowout number this morning for the jobs report. And if we got that blowout number, people were expecting that to trigger potentially a December taper of QE. But what we got was a number that was decent. It was above what expectations have been recently, or heading into this week, I would say. Wall Street expectations were placed at around 185,000. But because of that strong ISM, because of that strong GDP, because of the strong jobless claims, expectations had grown. People were expecting that blowout number, like I said. So you really had to, keep in touch with expectations and keep in touch with the news flow. And that's one thing that Twitter is great for. Twitter is great for hearing a lot of voices, seeing what expectations are in real time, as opposed to looking at some news service telling you what Wall Street expectations are, which isn't always the accurate expectation. And this morning, like I said, the expectation was for 185,000. We got 203,000 job ads, which was a solid number. And initially, the futures ticked lower as a result of that, thinking that maybe that might spur a December taper of QE. But then I think people started to analyze it a little bit more besides just that initial shock reaction. They said, you know what? They're not tapering after this report. We need something a little bit more. We need faster growth than just what's been status quo if they're going to taper QE. And especially, I don't know what Janet Yellen, people who think that we're going to taper in December, I don't know what Janet Yellen they've been listening to, because the Janet Yellen I've been hearing is not one that has any eyes on any sort of tapering, and has even said things like she thought the Fed could have done more to help the recovery over the past few years and going forward. So I definitely don't think personally that we're going to see a taper in December. I don't think we're going to see a taper any time before March at the earliest, and I think that's bullish for the market. And the price action we saw pre-market and today in different sectors would lend credence to that opinion that QE is likely to continue indefinitely. At the earliest, maybe they might trim it a little bit in March 2014, but that's the market we're in. I don't think the trend's going to change. I don't think a whole lot is going to change until that time at the earliest, so you'd be best served to follow the trend. Anyways, we'll take a look at some charts after that little soapbox diatribe. Take a look at the chart of the spiders. As I said, most of the action took place pre-market. Initially, when that report came out, people said, oh, it's above Wall Street expectations, not good, QE is going to end. But then, like I said, people analyzed it a little bit more, and the futures caught a bid pre-market for a really healthy gap up that reclaimed 3 days of losses in the market. As we talked about, yeah, that correction, we had 5 straight losing days, which has been a rare sight in 2013, but all the selling on these days was very mild. And even today, we didn't finish with huge gains or anything like that. None of the indices were up over 1%, I don't believe. But we still reclaimed 3 days of losses and some of a 4th day. So already back near highs despite not having any sort of, it wasn't really a gap and go to the upside. It was just sort of a gap and rest, a gap and nap, something that we've seen sometimes in 2013. So like I said, though, I don't think the status quo has changed at all. With this 5-day pullback, I think it was very healthy to see that type of price action, work off some of the overbought condition, maybe give us a little bit more room for a rally, Santa Claus rally into year end. And like I said, I don't think that QE is going anywhere anytime soon, and the action in terms of sector analysis today would support that opinion. We saw defensive sectors like that pay a high dividend yield, like the utilities, like consumer staples. Those are sectors that do well during QE and that have done well this year relative to what you normally see in terms of price appreciation for dividend yielding stocks. So you take a look at the chart of the XLU, which is the basically the number one sector for dividend yield and for safety and that type of theme. It was the strongest sector today relative to its normal performance and beta. You can see here, big igniting bar for the XLU. Sort of, like I said, people were expecting sort of a blowout number. with the jobs report that might spell an end for QE earlier than most people expected, but we didn't get that blowout number, and so I think it was a little bit of a relief move for the XLU, the utilities, and I think that could continue into the rest of the year. In terms of a long-term thesis, I love the utilities. I love these dividend-type stocks. I think we're going to be in a low interest rate environment for longer than people expect, and these are the stocks that perform well in that environment. So definitely doesn't give you the momentum that high beta tech and social media and 3D printing stocks give you, but different strokes, different goals for different folks in the market, and I think the utilities will continue to perform pretty well, at least through the first quarter of 2014. Also take a look at the chart of the XLP. Consumer staples, a lot of stocks in that group also pay a very high dividend. Take a look at the chart there. Another day of really impressive action. Yesterday started breaking down a little bit after a sort of gradual decline, perhaps in anticipation again of this month's jobs report, but a really nice gap and go to the upside today for the XLP. It showed relative strength same way the utilities did during the session, whereas the spiders sort of finished flat, barely positive from the open. The XLP was a gap and go back above its short-term moving averages, the 8 and 21 day. So really impressive action there. And then you go beyond the defensive sectors performing well, and you continue to see the theme that we've talked about for the past few weeks, divergences across the board. Especially in tech, it's hard to really get a beat on that sector as a whole, as you have stocks even within smaller sectors within tech diverging a lot. And we'll just take a look at some of the big names to show you some action there. Overall, it was a very choppy day, and it's been a very choppy couple weeks in the market. You haven't really gotten a whole lot of calculated type patterns, except for a select few stocks to play. But we'll take a look at Apple. Apple's one of the ones that has actually provided some nice setups of late. We highlighted this descending triangle bullish pattern in off the charts. We already hit our target over the span of about a 5-day move. But then today, the last 2 days, you've seen a little bit of profit taking, despite the fact that analysts tend to be raising their estimates on Apple. Obviously, really nice price action. You have people like Carl Icahn, Leon Cooperman have bought into the story. You have a lot of people supporting the stock now. And generally speaking, the value, if you're looking at it from a value investing standpoint, tremendous value right now in Apple. And I think Apple, despite this 2-day pullback, I think it's one that you should continue to look to buy on dips. You had the China Mobile deal looks like it got finalized. You have the new iPad has been getting rave reviews, and Black Friday sales were through the roof, much higher than anyone expected. And it's done all of this year. It's bounced back more than 40%, despite the fact that it hasn't launched any real new products. Yes, it updated its iPhone and iPad lines, but no wearable devices, no new TV set-top box or anything like that. So a lot of things still in the arsenal for Apple that they haven't unveiled, and the stock's still been able to stage this type of impressive bounce. A lot of things align right now for Apple, and I think it's one that, like I said, you continue to look to buy on dips. And then Google, another stock that I love. On every time frame, it's performed extremely well. And then today, another nice day for Google. Was able to bounce off of its lows of the day after a little bit of weakness during the session, but made new highs again. Not really a gap and go that you'd love to see momentum through highs, but nonetheless, really strong action there. Another one that any significant dip that you get in Google, I think, is a buying opportunity. And then you saw some weakness from other groups in the market today. If you were just clicking through individual momentum stocks that you watch in the market, you might have been scratching your head a little bit about how the market was able to finish with decent gains today. Because as I clicked through some of the names we've been watching recently, there was a lot of technical damage in various charts. Take a look at the solars, for example. The solars, a lot of weak action within the solars. The sector leader, FSLR, breaking down out of sort of an upper level base pattern now below 8 and 21 day moving averages. Look at TSL, Trina Solar, big time selling today there as well. Sort of broke lower out of a bear flag pattern after weakness yesterday. Take a look at the chart of CSIQ, Canadian Solar, another name, weakness, just weakness throughout that group. One of the groups that we've been talking about that's been performing very well and looking good technically, but is breaking down a little bit. Take a look at the chart of Facebook. Facebook wasn't necessarily super weak, but a bearish engulfing bar today. You saw it initially look like it was going to push higher, continue higher, maybe shrug off some of the concerns that people had about the fact that it did not get added to the S&P. This big breakout that we saw on Wednesday, or this big igniting move, a lot of that was due to reports that S&P could be adding Facebook and removing another stock, but instead they added a different stock, and so there was a little bit of initial disappointment. People thought that maybe Facebook could shrug it off, but this engulfing bar today maybe puts the brakes on that thesis and may lead to a little bit of corrective activity for Facebook. But then, like I said, divergences, divergences, divergences. LinkedIn, big time move today, if I can type it. A big time move here for LinkedIn, one that hasn't really been at the forefront of people's minds within social media. There's been more of a focus on Facebook and a focus on Twitter, but nice move here from LinkedIn today. Could get back in the game as well. We can zoom out on this one to see what we see in terms of more macro pattern, and what you see is a descending channel that looks like it might want to break to the upside. Like I said, been a little bit out of focus, but sneakily just holding in this type of pattern. If we can get some more momentum from today's bounce, then I think we could definitely get some type of move back to near highs for LinkedIn. We'll go back to a daily chart, move on to some other symbols, and then you talk about, my line tool, the casinos. The casinos are a group that we highlighted over the past 2 weeks as a group that looks like money's rotating into that group. It's all about sector rotation. It's all about divergences like we've talked about. And Las Vegas Sands, look at this huge move and commitment to the upside. Today, it probed the lower levels of yesterday's candlestick a little bit, but still bounced really impressively off the lows and finished with gains. So maybe in the short term needs a little bit of rest, corrective activity, but the type of price action we'd love to see there. It hit our targets from off the charts from when we listed it earlier this week, so we removed it from the watch list, but it's one that I suspect that if it can get some sideways type action, we might look to add it for another move on LVS. Then MGM. That'll come up for me. MGM sort of took the mantle today. Las Vegas Sands has been the strongest one in the group, but then the other ones are sort of following suit a little bit. Nice move there from MGM. Could get back to highs around 21. Then you look at Wynn. Another one, wide range today, but still on the precipice of a breakout here for Wynn. Las Vegas Sands a little bit stretched. Wynn is a little bit stretched from its 8 and 21 day right now. It's another one, though, that with some sideways type action could be poised for some momentum on a breakout there. There are some other individual stories today in the market. You had a stock like IOC. We can just take a look at that chart. Obviously, not exactly what you'd like to see there. Just about a 40% down move there in that stock. I didn't follow the news on it, but definitely not healthy to see that type of move in a market. And the JCPenney, looks like the fairy tale might be over a little bit for JCPenney. Obviously, had that nice bounce, great percentage move, almost or more than a 50% move off the lows of 6 and change, as people maybe thought that people were talking about the death of JCPenney a little bit prematurely, but had a 10% number, which was the same store sales growth from the year ago period, but that wasn't quite enough. JCPenney is in a downward spiral, losing money every quarter. They need to really turn things around and turn things around quickly, and that 10% increase in same store sales was not quite enough, didn't surpass expectations enough to trigger a further upside move after a more than 50% gain over the past month and a half or so. So 3 days of really harsh selling there. Hard to see much of a silver lining here for JCPenney, but keep an eye on it, see if it puts in some type of red dog reversal after this really extreme selling. Anyways, that'll about do it. Like I said, most of the action today took place pre-market, so wasn't a ton to do from an intraday perspective. And in general, just walking around the trading floor, I take a little bit of a longer-term perspective than some of the traders that I bump into on a regular basis. And from a short-term trader's perspective, I've noticed a lot of frustration. And I'm thinking to myself, the market, you had to have 5 down days, a little bit of choppy action, but if you're complaining about the market in 2013, you're definitely a little bit spoiled. The 5 days wasn't really harsh selling from a macro swing intermediate perspective, nothing to cry about at all. And I think in general right now, when the market becomes a little bit choppy like this, I think you just have to narrow your focus. You have to sit on your hands a little bit, and especially after a gap up like today that erased 3 days of losses that maybe it was a little bit of an exaggerated move based on some news today. I think, and Scott talked about it on Twitter, and some other people were talking about it on Twitter today as well. Today's the type of day where you don't chase stocks, you don't get over aggressive, where you just be content with either not doing anything or letting some longer term positions you have work themselves out. But in general, I think we could get a melt-up type action into the new year, and I don't think there's any reason to fight the tape. Maybe some sideways type action after today's gap up, and we can try to find some new bullish setups. While we do have a lot of divergences in this market, it's healthy to have a stock picker's market and be able to identify individual stocks that are showing relative strength to the broader markets. Anyways, one thing I want to add is that this weekend and over the next week or so, until supplies last at least, we have a holiday education bundle that we're promoting. That basically, for 2014, what we're doing is we're taking all T3 Live education courses and we're putting them digital. We're putting them all online. We're making it an interactive learning process. It's going to be really great. If you haven't been involved in one of our courses before, I think 2014, everything just continues to get better. Our education, we add new contributors to our site. We add new courses. We add material to all of our courses. And we're putting it all online. It's going to be a great experience, but that also means that we have some hard copies left over of our manuals. We used to, with our courses, if you bought a course, we'd send you a hard copy manual, sort of like a textbook, which is, it's great to have that hard copy to sit there and be able to reference it. But because we're going digital, we have, a handful, a few dozen copies of our course manual still left over. So what we decided to do is bundle all 5 of our courses, the manuals only, and we're selling those all 5 for $500. And just to give you some perspective on the value there, we're selling them basically for $100 each, the manuals. Those courses, they also include video, but the courses themselves retail for $1,000 to $2,000 each. So you're talking about, probably about a $7,000 to $10,000 cost for that course bundle if you were buying it retail from us. But instead, we're giving you the course manuals, which, like I said, doesn't include the video, but you still have tons and tons of information, tons of charts, tons of great education, definitions, strategies that we teach of all different types. We have a short-term momentum trading course that teaches you about, trading in the morning, trading setups off the open, and how to read the tape, all different things that Mike Lee and Steve LeVay and the T3 Live VTF talk about. You have the swing trading course, which is basically Scott's methodology for swing trading on an intermediate term time frame. You have the active trading course, which is our signature course that has all kinds of different strategies, reversal strategies, and how to use time frame analysis and tons of other lessons. You have a fundamental trader course, which the individual who created that course is no longer here, but it's an amazing resource textbook for understanding value, understanding fundamental analysis. And then you have Rob Smith's In the Black course, which Rob Smith has an outstanding system. The people in his room swear by it. It's a little bit of an unorthodox approach to technical analysis, but I think in today's market especially, you have to take a little bit of a contrarian, a different type of approach if you want to have some sort of edge. And I can tell you that the people in Rob's room, and my experience following his strategy, is that it's outstanding, and you're also going to get an introduction to that course within this holiday bundle that we have coming out. So anyways, 5 course manuals, $500. You're very unlikely to see an offer like this ever again from us. It's due to the fact, like I said, we're putting our courses online. We have a little bit of extra inventory that we're trying to get rid of, and we thought it'd be a great gesture to our community to offer all these courses in a bundle for a low price, so that basically you can go through, read these courses, learn a lot, and then figure out what strategy, what approach is right for you. So that'll be posted. There's a banner on our homepage. The link will be in this article that's below this video. So take advantage of that if you're interested in some trading education. Anyways, this has been John Darcy, your editor-in-chief here for the Daily Recap. We'll see you back here on Monday for the morning call.